Physical Gold Fund presents The Gold Chronicles with Jim Rickards and Alex Stanton. Insights and analysis about economics, geopolitics, global finance, and gold.
Hello, this is Alex Stanzik, and welcome to another edition of the Gold Chronicles. Today is July 26th of 2018. I have with me again today my friend and colleague, Mr. Jim Rickards. Welcome, Jim.
Thanks, Alex. Great to be with you.
We've got a very interesting topic for our listeners today. And before we dive in, I'd like to do just a very quick recap of our last podcast. We talked about things ranging from the new axis of gold. We covered why Russia has been accumulating gold for 38 consecutive months. We talked a good bit about financial warfare. And we also covered a really interesting game theory scenario in which Russia and China collaborated on a permissioned distributed ledger that would be used to settle payments between sovereigns. That, by the way, generated quite a bit of discussion on our channel. If you want to access any of our past podcasts, you can do so at physicalgoldfund.com/podcast. Of course, we've got a YouTube channel. Speaking of which, if you're watching this on YouTube and you like this content, you like the material, please take a moment to subscribe and like, as well as feel welcome to comment in the comments below. We are happy to discuss. So diving into today's podcast, Jim, you recently mentioned that you have accumulated some evidence that there is already an existing gold standard which is pegged to SDR 900 per ounce. Talk to me about how you came to this evidence and why you think this.
Sure. The evidence was interesting, Alex. As you know, I look at the U.S. dollar price of gold continually. I buy gold, I hold gold, but I'm not an active buyer and seller. I'm not looking to make quick profits. I consider it part of my permanent portfolio. I buy it, I put it away, and that's that. Sometimes the price goes up, sometimes it goes down, but that's not really most relevant to me. What's relevant is getting a percentage of my portfolio into physical gold. And, then as I say, I cap it at about 10%. That leaves 90% for everything else. And that could be, alternatives, fine art, private equity, real estate, stocks, bonds, whatever. We can talk cash. We can talk about all that. But, so I do make that allocation. Having said that, I look at the dollar price of gold multiple times per day because I talk about it a lot. I write about it. I talk about it. Obviously like to know what it is, see what the trend is, and see what we have to say about it. And I also look at believe it or not, I'm enough of a geek. I look at the dollar price of the SDR. It's not a secret. The IMF publishes it on a daily basis. It's just once a day. It's not actively traded. If you want to buy or sell large blocks of SDR denominated notes, you do that through the IMF. They have I call it a secret trading desk. It's secret in the sense that the results are not known, but it's there and people use it, and SDRs do move around. We only know that because we can look at the reserve position of countries that publish the reserve positions, which is most countries, not all, but most. And we can see the SDR line. It's usually small in relation to total reserves, but it's there. And we know what they've been allocated by the IMF because there've only been half a dozen or so allocations, but that's over 50 years. So it's a very long period of time, and most of those happened in the early days, late 60s, early 70s, and the last one was 1980. And then it's been radio silent ever since, all the way to 2009. So almost 30 years at that point. Then they came up with a recent allocation. We have that information as well. And the recent allocation was quite large compared to the older ones, but that's inflation and that more or less accounts for that. So we have those allocations. We know what they are by country. And then we can look at the actual SDRs that you have, and we see situations where you might have a lot fewer SDRs than you allocated. We have other situations, and that makes sense. You got a bailout or a loan from the IMF. They gave it to you in SDRs. Now you can take those SDRs and call the IMF and say, hey, thank you, but I need dollars. And they're like, okay, hold the phone and we'll call around and see who wants to swap dollars for SDRs. And we'll do that, and you'll get the dollars, they'll get the SDRs, everyone will be happy. So that goes on. And then, most interestingly to me, at least, we see countries that have more SDRs than they were allocated by the IMF. That means that they bought them in the secondary market, either directly from the IMF or one way or another. So they're moving around. They're getting reallocated. There are secondary market transactions. It's just not a robust or typical or transparent market. It's a little bit more like the gold market at the BIS, the Bank for International Settlements in Basel, Switzerland, does act as an intermediary, trades gold on behalf of its central bank members, but we don't know when, we don't know how. We just kind of know that the gold shows up someplace else. So that's going on. And I look at the dollar value of the SDR just as a frame of reference. But there's a third number that comes out of that, which I hadn't looked at because there's not much of a market, which is the SDR price of gold. What is it? Where's it going? How's the trend, et cetera? Because the dollar is almost 60% of the SDR, makes sense. 60% of global reserves are in SDRs, and that it follows that if the dollar price of gold is moving around, the SDR price of gold should move around, which it does. And but suddenly, as a researcher in Switzerland, don't know much about him or her. I don't even know if it's a him or her. The name is D.H. Bauer. Zug, Switzerland, sent me an unsolicited manuscript via a third party, so it kind of arrived through the back door, but there it was. And I looked at it, and it was striking. I actually first didn't believe it. I duplicated the research. I said, well, this is interesting if it's true, but somehow I doubt it's true. And then I duplicated the research and found out that it was true, which shows that the correlation between the dollar gold exchange rate and the dollar SDR exchange rate, what's the SDR price of gold rather. Sorry, I said dollar SDR. I meant to say gold SDR. So the dollar gold exchange rate and the SDR gold exchange rate were, in fact, highly correlated, as I expected, up until October 1st, 2016. Then there was a big change. And the change was that the dollar price of gold continued to go higher. It's leveled off recently. It's gone down recently, but overall it's up. And it's kind of jumpy and volatile and all the things we experienced firsthand. But the SDR gold exchange rate flattens out right around 900. And that the range above and below is quite small, smaller than the dollar gold exchange rate. The trend is not higher, it's flat, and that the trend line, so you run a straight line through the trend. So, okay, what's the trend line? It's flat. And this obviously happens on October 1st, 2016. We say, well, okay, what happened on October 1st, 2016? The answer is that's the day the Chinese yuan became a member of the SDR. So two interesting facts. I'm dealing in facts. We'll talk a little bit more about speculation, but the facts are that starting the same day the yuan became part of the SDR suddenly pegged to the dollar. It was pegged at 900 SDRs exactly. A little bit higher, a little bit lower, but that range gets narrower. So it starts out 850, 950, but stays in the range, unlike the dollar price of gold, which continues to go higher. But that's just the result of the dollar weakening against the SDRs. So you need more dollars, but fewer SDRs to buy the same quantity of gold. And then the range gets narrower. Today, I put it at 875 to 925. So that's an even narrower range, as I mentioned, pretty tight, about 2.5% above or below, not higher than that, and it stays very tightly within that range. Went out recently just a tiny bit. If you say 875 is the low, it hit 873. Okay, but it's sort of moved back up towards the 875 level, and it's getting back inside the range. So first thing you notice is that it's in a range, and then you say, why is it in a range? It looks like an auto regression. In other words, you say, okay, it goes up, it goes back down, it goes down, it goes up, but it stays in the range. It doesn't drift higher or lower, for that matter, as the dollar gold exchange rate has. And you say, well, what's up with that? And there's no explanation. There could be an explanation, which would be manipulation by a major central bank, but there's no explanation other than manipulation. In other words, there's no functionality, there's no causal factor, there's nothing in that relationship. The dollar gold price trades freely, the dollar SDR price at least appears to trade freely. Maybe it doesn't when you look at foreign exchange rates. But it doesn't look like there's any reason why the SDR price should be pegged to gold at 900, but it is. Then you say, okay, interesting. Who's behind that? And through a process of elimination, you start with 4 potential powers. Those would be, we know who they are. They're the United States Treasury certainly has the wherewithal to do that. There's the something called SAFE, State Administration of Foreign Exchange, which is a Chinese controlled foreign corporation or sovereign wealth fund. There's the IMF itself, which has the ability to print SDRs. And then there's the European Central Bank acting on behalf of its members. The thing about the ECB gold, they have the most gold under one roof, but it's spread around a little bit among the members. Total 10,000 tons. That's more than the U.S., but it's here and there. There's 3,000 tons in Germany, 2,000 tons in Italy, 2,000 tons in France, and so forth. And a few others. Netherlands has maybe 600 tons and a few others, but that's that. There really aren't any other players who have enough clout, who have enough, you need a lot of things. You need some SDRs. That's good. You need gold. You need cash. You need dollars. You need foreign exchange. You need euros. You don't necessarily need a lot of yen. China has a lot of yen, but you don't need a lot of yen. The yen is actually a very small part of the SDR, but if you want to mess around with the SDR, I would do it through the euro-dollar exchange rate. The dollar is about 58%, but the euro is, let's see, I got the exact percentage here. Bear with me a second. The euro is over 38%, so it's not as big as the dollar, but it's pretty big. Certainly, if you wanted to mess around with the dollar value of the SDR, one way you would do that, it would be to sell dollars, buy euros. So it's doable, but you need a lot of foreign exchange. You need a lot of cash. You need a lot of gold. You need a lot of SDRs. And you need a reason. You need some reason to do it. And China sort of fits in all those categories, as do the others. if they felt like it. But they don't. The U.S. and the ECB are pretty transparent about their gold holdings. I'm not saying they couldn't trade gold without some ability to keep it. They don't. It would show up. You'd see it in gold of the U.S. going up or down. You would see it in gold of ECB going up or down. You don't see that. You don't see those movements, at least not today. So take those two off the table. The IMF, again, they have their secrets, but they're pretty transparent about gold. They publish and report and make known their position of gold. We haven't seen any changes in their gold position since 2010. There were changes in 2010 worth noting, but nothing more recently. So let's take them off the table. And that leaves SAFE, and SAFE is completely non-transparent. They, unlike the People's Bank of China, the People's Bank of China, I would say, is transparent, but they're a little bit of a front, meaning they report what they want to report and they don't report what they don't want to report. And if they don't want to report it, they keep it in SAFE, which does not report publicly. SAFE is run by a former PIMCO guy, very sophisticated guy. And so there they are. So just through that process of elimination, I would put SAFE at the top of the list. I can't prove that SAFE is doing this, but I can say, based on all the facts, that they are a likely candidate, maybe the most likely candidate. They have the reason, which is, a desire to get out from under the dollar hegemony. They share that desire with Russia, with Turkey, with Iran, with others that form what I call the new axis of gold. We've spoken about the new axis of gold before. Now what we're doing really is taking that and expanding it and saying, oh, well, it's not just the new axis of gold, but they're starting to act on that and produce results. So that's sort of that. Those are all facts. Everything I just gave you is a fact. Now, how likely is it that SAFE is the transacting party? Can't prove it, but it seems highly likely. They have the wherewithal. They have the reserves. They have a reason for doing so. They have reasons for non-transparency, and they're not advertising it. And so, in all those respects, they look like a very likely candidate, even though we can't quite prove it. So, but let's just say they are. Now we're into speculation, but I think it's reasonable speculation. So, SAFE is doing this. You might say, okay, interesting. Why 900 SDR? 900 is the middle of the peg. It's the target, the ideal price. Where'd that number come from? Well, if you look at the total SDRs issued by the IMF, it's just over 204 billion SDRs, not US dollars. The SDR today is about $1.40, so that would come to $285 billion. But let's stick to SDRs. So 204 billion SDRs. How much gold does the IMF have? If they were behind this, I don't think they are. By the way, I don't think they're doing this. There's no evidence that they're doing it, but they have 2,814 metric tons. If you multiply that by 2,200 troy ounces per metric ton, that comes to 90,472,000 and change ounces. So let's just do a little bit of math. Take those troy ounces, turn them into regular ounces, the ounces that you and I know, comes to 6,190,000 and change pounds, 16 ounces per pound, divided by 90 million troy ounces, 90 million and change, times 0.911458. That's just a conversion factor to get you from troy ounces to regular ounces. So we make the troy ounces go away. That comes to about 1,200 SDRs. But if we say, okay, interesting, but we don't need 100% cover, that would give you 100% cover. We don't need that. let's assume 40% cover. That's how much the United States had, by the way, from 1913, when the Fed was started, to 1945. With 40% cover, you come to 480 SDRs per ounce. Interesting. So let's just take the two. Let's take the 40% cover, which is the extreme amount of gold, and let's take 100% cover, which no one really thinks you need, and just take the midpoint. Well, the midpoint is 840.6 SDRs per ounce. Pretty close to 900. And by the way, 900 SDRs, well, sorry, 40% cover, let's use that number. 40% cover was the U.S. official gold standard from 1913 to 1945. After 1945, we lowered it. After 1968, I believe, give or take a year, we lowered it again to 0. And then 1971, we stopped redeeming. And then ever since then, it's been no gold standard, floating exchange rates. So the gold standard has gone away in stages, starting in 1933. But from at least 1913 to 1945, we did have the law was you needed 40% gold to back up your currency. Most people thought that was sufficient, more than sufficient. And so using that as one extreme and 100% as the other extreme, taking the midpoint, 840.6. Interesting, not too far from 900. Proves nothing. The math is right. I'll vouch for the math. I can't vouch for more than that, but it's interesting that we seem to have a likely candidate in the form of the Chinese State Administration of Foreign Exchange, which is a secret sovereign wealth fund, and also we have a motive, which is to get out from under U.S. dollar hegemony. And we have the capacity. They have the reserves. They have the gold, the SDRs, the cash, the dollars, the euros, really everything they need. So they're the most likely transactor, but I can't prove it. But it's based on what we do know, based on facts. I'll put them as at the top of my list as the number one, as I say, most likely transactor. So we can see it's going on because it can't happen without manipulation. We have a very likely candidate, which is the Chinese State Administration of Foreign Exchange. We have a motive, which I've already described, and as I say, a lot of reason to believe that that's exactly what's going on. So that's where we are now. What does that mean in terms of first of all, the predictive ability, and secondly, where we think gold is going to go? Well, for one thing, we know that the members of what I call the axis of gold. Now, the axis of gold is a little different than the transactions pegging the SDR to gold. The SDR to gold looks like China, but it could involve Russia, in secret ways that we don't understand. But just taking open market data, assuming it's correct, and I think for Russia and Turkey it's correct. China, not so clear, but if they own more gold, then they own more gold. But Russia's gold reserves are approaching 20% of the total reserves. That's a pretty high percentage. Interestingly, the United States is 70%. You tell people, say, "Oh, gee, United States, what are their foreign exchange reserves?" Well, the answer is 70% gold. That comes as a shock to a lot of people, but it's true. We're like, well, we don't need all those. We don't need a lot of euros and yuan and Canadian dollars. We can go buy them if we need them. What we need is gold, and we have it. But Russia is approaching 20%. Turkey is over 10%. China is kind of struggling to get to 5%, bearing in mind that China has $3 trillion of reserves. So they started with a pretty big reserve position before they woke up one day and said, maybe we need to get out of dollars. Which they're now doing in their own slow way. We don't have all the information. But China's going up, Turkey's going up a lot, very steeply. Russia, steady Eddie, just, kind of keeps going up like that. They've been a little more transparent about their reporting. But we have that information. There's a definite turning point. Official gold holdings hit an inflection point in 2008. Interesting time. We were at the bottom of a pretty bad recession at the end of 2008, early 2009. And yet that was the bottom year for gold as a percentage of total reserves. Gold fell to about 30,000 tons officially. But today it's back up to 33,000 tons, which is where it was in 2000. So we started 2000, we went down like this, and then we went up like this, and we're back where we were 18 years ago. That's an interesting turnaround and an important one, except that the developed markets are up a little bit. Can't say zero, but not a lot. But the emerging markets have made up the difference. They've engineered this turnaround, and emerging markets include Russia, China, Turkey, Iran, and some of the countries I mentioned. So, interesting what's going on there. Beyond that, the dollar, superficially, it's the king reserve currency. There's still no question about that. It's 60% of, I'll use round numbers, 60% of global reserves, 80% of global payments, almost 100% of oil pricing. Those are big numbers. That's a big deal. The dollar is still king of the road, but the fact remains, all those are lower than they were, and oil looks like the next one to start heading south. We'll start to see more yuan priced oil, and in other leading currencies. Maybe Brazil will charge its local currency for oil, remains to be seen. But the dollar is going down. In the last 4 years, it's dropped from 66% to just over 62% as global reserves. Well, 4% of global reserves, that's a big number. And likewise, it's declining as a percentage of total payments, and even slightly now as the price of oil. Meanwhile, gold is going up for reasons I just mentioned. So we do see a gradual substitution of of gold for dollars, gold pricing, yuan pricing, etc., of oil instead of dollars, reduction of dollar reserves. Not extreme, not a collapse, but little by little, things are moving in that direction. I think it's smart to take account of them. And at the same time, we see the formation. I wouldn't say this is completely formed or operating. It's not, but really the beginning of a cryptocurrency exchange that is really distributed ledger technology, denominated in SDRs, free of U.S. interference and sanctions, that would involve, at least two currencies. Let's call it the Putin coin and the Xi coin. You can call it anything you like. Could be the same coin. Could be the Asia coin. Could be a lot of things. But they'll, suddenly North Korea will sell Iran weapons. Iran will sell oil to China. China will make fixed investment in Russia. Russian tourists will go to Turkey. And the Turks will buy pistachios from Iran. There'll be more going on, but I just point that out as an example of the trade among those countries that suddenly will not involve dollars. It'll involve, let's call it an Asia coin. It'll settle and clear through its own network. It'll be encrypted, very difficult for the U.S. to hack. And then periodically, and whether that's monthly, quarterly, annually, remains to be seen. Based on balances, of course, the net payments are always smaller than the gross payments. But when you net things out, plus and minus, the net payments could be settled in gold. And they could be put it on a plane, put it on a pallet, fly it from Tehran to Moscow, or Moscow to Beijing, or Beijing to Ankara, and the story. So we're starting to see that. It doesn't from far behind where we are right. You do have this odd conglomeration of things where Russia and China want to get out from under the dollar. They're actually, one of the ways they're doing it is by building up SDRs, but then pegging the SDR to gold. So in that sense, the gold is hedged, and likewise the hedge is constant, so you know what you're dealing with, and that ties in to the amount of gold the IMF has, which I explained earlier, and so it's all happening now. Is this all happening under one big giant conspiracy? Probably not. But it's probably being directed by the Chinese to a great extent. It's probably being led by them, even if they're not in charge of every step. I say Russia has gone its own way on gold, but China's all for it. China's doing their own thing in gold in their own way. Turkey's breaking out in gold. Iran is breaking out in gold, even though Iran's not transparent. So these things are happening. Now, are they earth-shattering in the short run? In the short run, probably not, although they're really, really interesting. One should pay attention to them. But in the longer run, they could be a very big deal, because you could end up saying, dollar price of gold, it's going here or there, but who cares? We have an SDR price of gold. It looks like this. We're accumulating SDRs. SDR is now a new gold standard. It's a safe asset for people to get. It's hedged by gold. We would urge you into the SDR and out of the dollar. Hard to see the IMF objecting to that. Probably wouldn't. But it kind of leaves the U.S. high and dry. It was like, oh, hey, we're 60% of reserves, 80% of payments, 100% of oil. But all of a sudden we're, 45% of reserves and 50% of payments and 70% of oil, and all those things are heading south. They don't look good. And then you get into a stampede kind of situation, at which point the dollar price of gold might not mean all that much. I'm not saying this happens overnight. It probably doesn't happen for a few years, but the initial steps have been taken. They're clear. They probably can lay them at the feet of the Chinese, even though we can't quite prove that. It's definitely worth watching. If I were a gold investor, I would care, because I would say, okay, dollar price of gold is going to continue to fluctuate, but maybe I don't care as much. Maybe I care more about the SDR, and I got to keep an eye on that. So it's a big deal. It's happening slowly, so slowly that most people haven't noticed, but the data is what it is. I have a presentation on this, which I meant to give in Vancouver last week. Unfortunately, I encountered a little illness and was unable to do that, but I will be making it available. Certainly make it available to readers at this conference, and we'll take it from there. So that's an overview. It has a lot of detail, it has a lot of facts. It doesn't have 100% facts. We have to make an inference or a leap when it comes to the Chinese involvement, but I think it's a reasonable leap, and definitely bears watching.
Right. So very interesting. I had a number of questions that came up while you were explaining this, and one by one you ended up answering them all. The first was, how would this happen? How could it be conducted to where there was something resembling some kind of a peg? And the answer is open market operations. If there was a central bank, or maybe not open market, but they can buy and sell various different assets to try to maintain that peg.
Yep.
Why does it exist? You did explain that as well. And what would be the motive for maintaining it, which would be to get out from under U.S. dollar basically dominance in terms of world reserves and payments. And then the question occurred to me, well, okay, well, isn't this going to require some kind of massive shift away from U.S. dollars in terms of reserves and for payments? You also addressed that question in that it is happening, has been happening. I actually knew. It took you saying that to remind me of it. You know, one of my colleagues who you know, Simon, says this all the time. He goes, is that what's happening with the change of the world's reserve currency is like the slowest train wreck in history.
Yeah.
You know, if people recall, the British pound used to be the world's reserve currency, and it took about 50 years for that to change. So,
right.
I don't know where you start measuring it from. But yeah, I can see how that would be a process, and makes a great deal of sense. So, Jim, that pretty much wraps up our time. That was a really great explanation of your view on that, and hopefully we can dig deeper into that as more information comes to light in the future. And so I just want to thank you, Jim, again for being with us. Appreciate the discussion. As always, look forward to doing it again next time.
Thank you, Alex. I look forward to it also. Thanks.
You have been listening to The Gold Chronicles with Jim Rickards and Alex Stanzik, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.